you always have to accept that. And then you probably saw that I posted up our last session. I'll put it under the appropriate chapter. That will happen for all classes that we have via Zoom. Unfortunately, I'm not going to be able to do that for our live classes because we don't want to encourage folks to not come to those. So, but other than that, I'll post those up and I'll post them up by chapter. Okay. So I'm going to go ahead and let me get this out of the way and put the slides up for tonight. We're in chapter 2. Okay. And I am going to put my computer tablet mode now. And you can see on the screen that we're going to really, to a large extent, start the course right here. I know we talked about FASB and the financial reports and whatnot, but remember that much of what we talked about in chapter 1, no, really? Sorry, guys, 1 second. I have just been on a roll of computer issues, guys. I just can't understand it, why I continue to have computer problems. And the problem today is my pen's not writing. And that's a huge problem for me because I do a lot of writing on the slides. But let me try and first get out of this. Something odd is going on here with this file. So let me see. Okay. The good news is that it doesn't seem limited to the pen. This file is responding at all. Okay. This is just really getting a little bit ponderous. 1 second, guys. Okay. Okay, so I got the video back. And okay, it kind of works there, although now my eraser won't work. Sorry, guys, 1 second. I just don't know what's going on with these machines, but 1 second. Okay, let's try it again. Okay, I don't know what the hell. Okay, all right, good. Well, anyway, it's working now. So remember that we said from chapter 1 that assets equal liabilities plus stockholders' equity. And remember, we said that assets have future economic benefit. And I think we all pretty much agreed that what cash is our favorite asset because we can turn that into any future economic benefit that we want in the confines of the law. So if we have $100 in one pocket, but we have a what, $40 phone bill in our other pocket, that's our bills, right? So we don't really have equity, owner's equity, stockholders' equity in that entire $100. We actually only own 60 of that $100, and that would be our owner's equity. And we said that that equation must always stay in balance. Assets equal liabilities plus stockholders' equity. Always got to stay in balance, right? Well, what we have on the screen here is this system called double entry bookkeeping. And under the double entry accounting system, we are going to see that we will always use a debit and a credit to record an accounting transaction. This is a system that has been around, as I mentioned, since the 12th century, and it has been in use all that time. Now, if a system has been in use for that long, what does it tell you? What does that tell you?
It's effective and useful.
It's effective and useful, and I think what you mean by useful too, right, is it must be pretty easy, right? If it was that complicated, then they would have replaced it with something else. And you say, oh, well, not necessarily, John. Well, look, the Roman numeral system, okay, was a bit too complicated, and they replaced it with the Arabic system that we use now, right? And the only reason you know Roman numbers is because of the Super Bowl now, okay? So what happens as better systems come up, and those systems are designed to represent what's going on around us, then we can replace it if we come up with a better system. Now, science can be as hard as it wants to, right? I mean, if you're trying to make an airplane fly, you've got to deal with the fact that you have to deal with wind velocity and whatnot, and it is what it is, right? But a system that is recording for us something else that's going on that we're observing, like business transactions, it has to be effective. It has to be fairly simple to use, okay? So if folks from the 12th century could understand this system, I mean, they thought that if you sailed off, too far, you fell off the edge of the world and you went into a, dragon's mouth or something, right? Okay, so if they could use it in the 12th century, we should be able to understand it and comprehend it here. So we're going to talk about that tonight. We're going to get comfortable with that. And we're going to see that this is going to be a key aspect throughout the course that we'll use as we talk about different accounting transactions. So assets equal liabilities plus stockholders' equity. And the way that we will always make sure that that stays in balance is by making sure that our debits equal our credits. Debit equal credits in this double entry bookkeeping system. Okay. So when you look at this slide, I'm just going to go ahead and show all the arrows here at once. This is a key slide. And guys, I know that you will learn this slide and I know that you'll be successful in this class. I put that up more for my undergraduate students that somehow, for some reason, think that there's a way to avoid knowing this. You must know this to be successful in this class. If you don't know this for our midterm, for our only exam in this class, you will not get a good grade on the midterm. You've got to know this, okay? Now, again, we're going to do the midterm, or the only exam we're going to have, the exam, I guess I should call it, on online. We'll take it in Canvas, and you can have this sheet in front of you, but it's very important that you know, get a pretty good working knowledge of this. Otherwise, you're going to be struggling even with this in front of you on your exam questions. Okay, so let's just go through this. And these arrows up and down represent increase or decrease. Okay, so if we want to increase an asset account, we have to debit it. Okay, so if we're talking about an asset, a debit is like a plus sign to increase it. So we want to increase our cash, which is an asset, from 100 to 200. We would have to debit it for 100. Okay. If we are trying to decrease an asset, the down red arrow, then we credit it. So that means that a credit is like a minus sign to an asset account like cash. Okay. Now, if we are trying to increase a liability, right, we will have to credit it. So a credit is like a plus sign to a liability. If we're trying to decrease it, we will debit it. So a debit is like a minus sign to a liability. For our equity, and remember right now, guys, our equity is what? Our equity is our common stock and our retained earnings, right? So to increase an equity account, you will credit it. To decrease it, you will debit it, okay? Now, revenue and expenses move like our retained earnings does. So since retained earnings is what? Is a stockholder's equity account, and since revenue minus expenses equals net income, and since net income does what? Increases our retained earnings, remember we talked about last time, then to increase a revenue, you should credit it. To decrease it, you should debit it. To increase an expense, you should credit it. And to decrease it, you should debit it. Okay. Now you've got to know these rules, guys. This is what makes accounting a little bit different than all the other business courses you'll ever take, and that accounting is one in which there's a very specific procedure that we follow to record business transactions. And this is the process right here. Okay. All right. So what I want to do is go ahead and remove these little clues. Okay. And let's just go ahead and let's do it together. Okay. So to increase an asset, you should, and you might want to unmute for this. Okay. To increase an asset, you should
Credit it.
Debit it.
You should debit it. Good. To increase it. Good. To decrease an asset, you should
Credit it.
credit. Good. Okay. Well, it's not going to let me do it. So let's just, and then I'll show you the answers because it's not going to go in the order that I wanted to. Good. You would credit it. Good. To increase a liability, you should
Credit it.
credit it. Good. To decrease it, you should
Debit it.
Good. To increase an equity account like our common stock, our retained earnings are two equity accounts right now, you should
Credit it.
Good. To decrease them, you should
Debit it.
Good. Excellent. To increase revenue, you should
Credit it.
credit. Good. To decrease it, you should
Debit.
debit. Good. And to increase my expenses, I should
Debit.
debit the expenses. To increase them. To decrease them, I should credit, right?
Yeah.
Okay, good. Gotta know this, guys. Okay, so this is a good slide of any to print. Sleep with it under your pillow. You know, when your roommate comes home tonight, whatever, say, hey, roommate, hey, honey, did you know that to increase assets, you debit them, to decrease them, you credit them, to increase liabilities, you credit them, to decrease them, you debit them, to increase owner's equity, you credit it, to decrease it, you debit it, to increase revenue, you credit it, to decrease, you debit it, to increase expenses, you debit it, to increase it, you credit it. To decrease it, you credit it for your expenses. You know, you're riding the bus and somebody that you don't want to sit next to you sits next to you, right? You just turn to them and say, did you know to increase assets, you debit them, to decrease them, you credit them? I promise they'll move, okay? You've got to know this stuff inside and out. You cannot mess with this, okay? Okay.
Sorry, quick question on this. I'm having a hard time actually understanding this, I think fundamentally, because the word debit, like I just think of it as, ripping money out of an account, right?
Mhm. Well, what generally happens with that is when you give money to the bank, okay, so you get some money, your cash goes up, right? But then you turn and you give that money to the bank, don't you? When you deposit it, you don't give it to them, but you deposit it with them. And so when the bank gets that money, does their cash go up?
Yes.
Good. So they'll debit cash to increase their cash. They'll debit it. Okay. But is that the bank's money or is that your money?
Kind of both, right? Or bank's money.
It's your money. Really?
Oh, it's my money.
Okay,
Okay.
if you believe that, I'm gonna open up a bank and tell me to give me all your money. Okay, it's your money,
Okay.
right? And so the bank would have to do what? The bank has a bill. They have to give you that money back. If you walk up and say, "Hey, here's my ID, give me my money back," they have to give it back to you, don't they?
Mm-hmm. Right.
Okay. So what they will do is they will credit, because debits equal credits. They will credit a liability, and that liability is going to go due to who's speaking right now?
Corey.
Due to Corey, right? Because they owe you that money. That's a bill. They got to give you that money back if you come and ask for it, don't they?
Right. Mm-hmm.
So when they say to you, "We credited your account," they're describing their accounting to you. Okay, you would have increased your cash on your books. You would have debited cash, right? Because your cash went up when you received that cash. And of course, you would have credited, let's say it was for a service you provided, you would have credited revenue, right?
Mm.
Right?
Yes.
Because you provided a service, your revenue goes up, so you would credit it. So when you provided the service, okay, you would have, this is, I'm not picking on you, Corey. This is Corey's accounting. You would have debited your cash and credited your revenue. Okay, then you take that money to the bank, okay, and you deposit it with the bank. The bank, okay, is going to debit their cash and credit what? Credit the liability. Now you're right, and that the bank could do what? The bank could loan that. Hello? Okay, can you go ahead and mute, please, if you're got ambient noise? The bank could what? The bank could then loan that money to somebody, couldn't they? The bank
Yes.
doesn't hold your money. So if they loan it to somebody, then they're at that point, that cash will come down. So they'll credit cash and they'll debit, say, loan receivable. Right? Because now they've got an asset, someone's got to give them that money back, and presumably there'll be some interest there, et cetera. So that's after they lend your money out, right? They don't sit there and hold your money, of course, under, Federal Reserve Bank rules and stuff. They have to maintain certain percentages of deposit. We're not talking about banking here, but bottom line, assuming they loan that whole amount out, let's say, they would debit loan receivable, credit cash. Corey?
Yes. Sorry, I'm here.
Yeah. I mean, are you okay? I know you're here, but are you okay? You're getting it now?
A little bit. I think I just need to sleep on it, I think, and then it'll hopefully go into my system. But I think
No,
so.
there's no sleeping on this. This is
Okay.
understood.
Uh-huh.
Do you understand that to increase cash, you would debit it? Yes or no?
Not really. I'm sorry.
Well, you got to accept it.
Right.
This is not like some theory that I'm explaining to you, when supply equals demand, there's equilibrium, and that's the correct price that everything. This is not that. This is, I'm telling you, To increase cash, you debit it. Have you
Okay.
accepted that?
Accepted, yes.
Okay, to increase cash, you debit it. So if you got more cash because you provided a service, right? You
Mhm.
have to debit cash, don't you? To increase it?
You have to debit cash. Yes, yeah. Debit cash to increase cash, yes.
Okay, all right, good. Guys, this is more like playing tennis than it is studying a class. So if I tell you, you have to hit the ball like this to get it over the net, you hit the ball like this to get over the net, you don't sit there and go, well, no, I'm going to do one of these things around the back. You know, you do what I tell you to, right?
For sure.
To return the ball over the net, that's how you hit it, right? Okay, so to increase cash, you have to debit it. So if you got some cash on your books, you debited it. And because you provided a service, you can increase your revenue. So you credit revenue, right?
Right.
Okay, that's what you got to do. You just got to accept that. Okay, then you take that bank and that money, I should say, and you give it to the bank. Well, the bank has to do their accounting, and their cash just increased because you just gave them $100. So to increase cash, they
Debit it.
debit it, and it's because they owe you that money back. If you come and get it, they have a liability. So a liability has increased, haven't it, for them? So what do you do to increase a liability? You
Debit it.
Okay, the blue arrow up
Oh, sorry.
means increase. It's right there on the screen, so you have
Okay.
to
Increase
credit
it.
it, right?
Okay.
Right?
Credit it. Okay.
Okay, good. Then what happens? Then the bank, I'm saying, takes that money and loans it to somebody. Did their cash go down if they loan that money to somebody?
Yes.
So how do they decrease their cash?
Credit it.
Credit it. Good, that's right there. And that money is going to have to be paid back to them, isn't it?
Yep.
So if someone has to pay money back to you, do you have future economic benefit?
Yes.
That's an asset, so you have to increase the asset loan receivable. So you to
Debit the
increase an
asset.
asset, you debit. Yeah. Okay,
Okay.
good. Now you
Okay.
got it. Okay. All right, good.
Thanks.
That's right. Look, right now there's a happy kid somewhere here in Hayward riding a skateboard, having a good time, doesn't realize that they're going to become an accountant and have to learn this stuff someday, right? So, nobody is born and says, I want to be an accountant. Usually they tried to be something else and they failed at it, and then they decided to get into accounting. Okay, so you can hang with it and you will get there. Okay, good. So to increase an asset, you debit it. To decrease it, you credit it, and so on. Got to know this. All right, good. Now, it's one thing to know how to increase assets, liabilities, stockholders' equity, revenue, expenses. It's another thing to know which accounts specifically constitute those categories, right? So we don't debit credit asset, we debit credit accounts, right? We're going to keep track of these different accounts. And so when you look at these accounts, and guys, just to get out there quickly, the red doesn't mean anything here. It's just wherever I borrowed this slide from. Some of them were red, and so I'm just using this, but red doesn't mean anything here, okay? But notice that my assets have what? Future economic benefits. So does cash have future economic benefit?
Yes.
Yes, it does. Accounts receivable, loan receivable has what? Future economic benefit. Supplies like paper, pens, you can use those pens for a while. That has future economic benefit. I'm saying pens because I'm saying I'm looking at a stack of pens here. Okay, but paper, pens, supplies, you can use those in the business. They have future economic benefit. Prepaid insurance. And for some reason, my students have trouble understanding that a prepaid item is an asset. And I can't understand why someone would have a problem with that. If it has the word prepaid, that's telling you I paid it in advance. It obviously has future economic benefit, doesn't it? If I prepaid it, okay? So when I prepay my insurance, it's gonna last me for a year, let's say. I have future economic benefits, so prepaid insurance is an asset. Equipment is an asset. Now, we're going to talk about depreciation a little bit later in the class, but just know that as we depreciate an asset, we report its depreciation right next to the asset. It's a subtract from the asset. We call that a contra asset account, and that's why they're showing it right there next to the asset. So let's just look at that for a second. Let's say I purchased some equipment. I'm not sure who's, if you're not saying something, guys, please mute and then unmute when you want to say something. Okay, I don't want to hear and fight with, let me.
John, I have a question for you when you're done with that there.
Okay, are you the one that's giving us the noise? No?
No, I'm muted.
Okay, I just want to mute where that noise is a little distracting for me. Okay, go ahead.
So I wanted to kind of compare what you said about prepaid insurance
Yeah,
to what we looked at. And I know last time it was a very, very dumbed down version of these books, but we had one line in a problem during our last remote meeting that was rent.
okay.
Is rent considered an asset because typically it's paid in advance?
Well, most rent is not paid in advance. Usually rent is actually paid in arrears. It's paid at the end of the month. And you may think that you're paying it at the beginning of the month, but you're really paying it at the end of the month. But if you did pay it in advance, then rent would be considered a prepaid. Yes, if you had paid it in advance at the beginning of the month. You know, I guess
the only experience
somebody makes you
rent
pay
is
it in advance. I'm thinking more of a home mortgage. When you pay your mortgage, you actually pay it at the end of the month. But for rent, yeah, for rent, if you pay it at the beginning of the month, so say you pay the rent for January on December 31st, and then you prepare your financial statement on December 31st, then rent would show up as an asset. Or let's say you moved in somewhere and the guy said, hey, look, pay the rent for the whole year and I'll give you a discount. I'll only charge you $100 a month. So you got to pay him $1,200 up front. Then when you pay that, of course, because you're decreasing your cash, your credit cash, and since the asset prepaid rent is now increasing, you'd have to debit prepaid rent. So it really depends on the nature of the arrangement. So in that example, they were just expensing the rent immediately because I guess they were paying it at the end of the month. So it already had expired. Future
Got
economic.
it. Thank you.
Yeah. Okay, good. So oh, come on. Okay. Sorry, guys. Okay, so let's take a look. I'm yelling at my computer here. Let's take a look at equipment. Okay, so let's say I pay $100,000 for some equipment. And let's say that equipment has depreciated maybe 10,000. So I will report accumulated depreciation and say it's 10,000. And so now that equipment will have a book value of 90,000. Okay. Now, when you look at that, do you think this company is going to have to buy any new equipment anytime soon? You're looking at that and you're thinking, okay, I don't see a big expenditure for equipment coming up, right? Okay, but let's say after a while, or let's say it's another company, whatever, okay, and you see the equipment is 100,000, and then you see, and I'm just going to abbreviate, accumulated depreciation of say 80,000. Now you see a book value, BV's book value of 20,000. Do you think this company is going to have to invest in some more equipment pretty soon?
Yes.
Most
Yeah.
likely, yes.
So in both cases, what happens? We sit here and we show you what we originally paid for the equipment. Remember, we carried a historical cost. But we show that what the value of that piece of equipment now has deteriorated to a certain extent because of use and time and whatnot. And we're probably going to have to cough up some more for some more equipment. Which company do you want to invest in?
The first one, because there's less expenses incoming.
Well, I don't know that there's less expenses incoming, because expenses constitute future economic benefit that has expired, right? So these two companies could have the same expense, but there's what? A cash outlay potentially coming for equipment, right? It's not an expense. Purchasing of equipment is not an expense, right? Purchasing equipment is not an expense. An expense tells me that future economic benefit has expired, right? When I purchase equipment, I don't debit an expense account, I debit an asset account called equipment, because I'm exchanging one asset for another, cash for equipment, right?
Yeah, correct.
Okay, but which company do you want to invest in here?
The first one.
You want to invest in the first one. Why?
Because you will not be crediting cash anytime soon.
Good, excellent answer. I'm not sure I agree with your analysis though, because what happens if you see a company that has tremendous growth in revenue by using equipment? Well, then I kind of like this company, because what? Because I'm seeing a growth in revenue. I'm like, here, take some of my money. I'm going to buy some of your stock, buy some more equipment, and keep this train going, right? Now, if it's a company that's been showing losses period after period, maybe I'm not too interested in that. It really depends on my perspective as an investor. I agree with your take on not wanting this company if I am looking for a dividend stock to buy. Dividend stock, and I am probably the one in this room, this virtual room, that would want to buy a dividend stock, because I'm old and I have to sit in my backyard pretty soon and get drunk all day and not work, right? So I need what? I need some dividends coming in to finance my poor behavior, right? You guys maybe are looking at this company and saying, hey, I'm seeing potential growth in this company. Let me give them my investment here, and I'm going to want to see them continue to invest in equipment, assuming they're using it productively, and that will cause the value of the stock to continue to grow, right? Okay,
Correct.
good. Okay, excellent. All right, so let's get all this junk out of the way now. Okay, so now you take a look, and that's just so you understand why accumulated depreciation is sitting there under the assets. It's really, they call it a contra asset. It is opposite. It subtracts from the asset, right? Accumulated depreciation. Okay, good. Remember, our liabilities are our bills, and so we have what? Note pay a bill, accounts pay a bill, salaries and wages pay a bill, interest pay a bill. Now, unearned revenue is also a liability, okay? So what does that mean? Somebody gives me some cash and says, hey, I'm paying you in advance now for your services. So let's say I'm the greatest, pen maker on earth, okay? Or I'm the greatest DJ on earth. And they want to sit there and they want to reserve my services for the next year. So they give me some money in advance so that what? So that I'm committed to provide them this service. So they give me the money and I have that cash now, but if I don't perform the service, do I have to give the money back to them? Somebody gives you money, you're supposed to perform a service, and then you don't perform the service. Do you have to give the money back?
Yes.
Yeah, 100%.
Absolutely. And if you don't think so, try it sometime. try having somebody give you some money for a service, you don't do it for them, you'll be in front of Judge Judy before too long, right? Okay. So what happens? The courts are going to tell you, give that person that money back. You can't take someone's money and then not provide a service per the agreement, right? Okay, good. So if I have to give them the money back, do I have a liability?
Yes.
Yeah.
Potentially have to get
Yes.
that money back. That's like a bill. That's a liability. So we put that down in unearned service revenue. Now, I think, like we were talking last time, I believe we were talking about this. Analysts tend to look at unearned revenue a little differently than they do other liabilities, and that what? It's saying that you are already booked for business going to the future. So analysts will actually look at the unearned revenue account year over year, and they like to see a nice steady growth in that particular liability because it means you've got what? You've got a good, nice stream of regular business coming and going into the future, right? Okay. Okay, good. Stockholders' equity, as we've said right now, are what? Our stockholders' equity accounts are common stock and our retained earnings. Now notice they put income and dividends right there under retained earnings. Why? Well, what happens? There's my signal for my, who's this?
The bank,
Okay.
your
There's
bank account.
There's my piggy bank, right? Okay, that's my retained earnings. Anyway, I shouldn't put it on the common stock because it's not relevant to the common stock. I'm gonna put this pig on a diet a little bit. Okay, make him a little skinnier, whatever. Obviously, I'm not an artist. Okay, so for my retained earnings, right? I have what? I have the BASE beginning balance, right? And then I add what? I add what to my retained earnings?
Net income,
Good. I add the net income. I subtract what?
dividends.
Good. Subtract dividend, and then that yields me my ending
And
balance.
balance.
Good. Excellent. So that's why under retained earnings, they put the dividends and the income, because that is where it's going, those items are going to affect my retained earnings. Good. Revenue is easy. It says revenue on it. Expenses are easy because expenses have the word what? Expense after them. Okay. So you have to know not just, how to increase an asset, you have to know what accounts constitute asset, constitute liability, etc. Okay. Now, when you look at these two slides together, this is the class right here. I mean, if you get these two slides down, there is nothing that I can do to confuse you on the exam. Okay, nothing. Okay, if you understand this, you can sit here and you can answer any questions that I'm going to give you on the exam. Okay, question. So I would go ahead.
Looking at the expenses, we have a depreciation expense, and we have the accumulated depreciation as asset. Does that mean that I already got the name of it, double entry system doesn't touch the equipment account? It goes one on the accumulated depreciation, one on depreciation expense, or how do you record that?
Yeah, well, yes, kind of. I mean, if I purchase the equipment, then I would debit equipment and just say I purchased it for cash. I'd credit cash, 100,000, right? And then the equipment account sits there. Right? For all those years as I start to use it, it just sits there. And then each year, as that equipment depreciates, I'm going to, where do I want to write this? As the equipment depreciates each year, I'm going to debit depreciation expense to increase an expense account, I debit it, say 10,000 per year. And I'm going to credit my accumulated depreciation. For 10,000. Okay, that's a credit. I'll credit my accumulated depreciation for 10,000. So when I prepare my financial statement, equipment still says what? Still says 100,000. The accumulated depreciation is how much? Is now 10,000. So when I report that, now I have the book value of 90,000, right? And I do that in year one. And then in year two, since this thing depreciates 10,000 per year, I'm going to go ahead and in the next year, I will debit my depreciation expense. Again, if I'm assuming it's going 10,000 a year, and I will credit accumulated depreciation 10,000. Now my accumulated depreciation has what? Has 10,000 from year one and 10,000 from year two. So now the accumulated depreciation is 20,000. So now the book value on that asset is 80,000, right? And each year it will continue to go down, down, down as I depreciate that asset. But the
I think
equipment.
what I'm confusing is the difference between what I'm confusing is the difference between the account value for equipment and the book value. So which one is reported where, if that makes sense?
Well, all of this is reported on the balance sheet because the balance sheet is assets equal liabilities plus stockholders' equity. That's why they call it the balance sheet, because it balances. So is equipment an asset?
Yes, sir.
Okay, and the accumulated depreciation, I've said, is a contra asset. That's why they show it there, because we show it against the asset, right? And then the book value is simply showing the difference between the asset equipment and the related accumulated depreciation. It's subtracting from the equipment, right?
Makes sense.
Okay.
Cool. Thank you.
Okay, good. We're going to talk more about depreciation in chapter 8. It's not, so don't take this to mean, oh, this is something I've got to know for the midterm. We'll get into a lot of detail about depreciation more in chapter 8. Okay.
I have a question.
Yeah.
Is it correct to say that end balance plus common stock equals stockholders' equity?
Retained earnings plus this is retained earnings, right? This is how we calculate retained earnings. Okay. So retained earnings, the beginning balance, add net income minus the dividend equals the ending balance of retained earnings, and retained earnings plus common stock constitutes stockholders' equity. Yes.
What's the difference between end balance and retained earnings?
Well, we have a beginning balance in retained earnings. Beginning balance is, say, 0. We add our net income, say 2450. We subtract the dividend. I'm just making these numbers up. I think we had an example that went something like this. And then the ending balance in retained earnings, 2450 minus 1300 is how much, guys? Guys, bring the calculator. I'm not going to sit here and I'm not going to be your
I think 3,750.
1150.
Subtract it. I subtract it. I subtract the dividend.
Oh, yeah.
Okay, so I subtract the dividend, and so the ending balance is now 1,150, right? So retained earnings, every account, frankly, has a beginning balance. There are adds to that account for the period, there are subtracts to the account for the period, and then there's an ending balance, right? So when we're talking about ending balance, we're talking about the ending balance in the retained earnings account.
Okay.
Okay. Okay, good. Question? All right, good. Now, this slide is helpful in that it shows now account category by account category, assets equal liabilities plus stockholders' equity, how you increase asset, how you decrease it, liabilities, common stock, retained earnings, right, are both stockholders' equity. And then revenue minus expenses equals what? Net income. So since net income does what? Since net income goes into retained earnings, notice that what? If I had more revenue than expenses, I'd have a positive net income. So my beginning balance, whatever that is, plus add net income, whatever that is, less what? Subtract what?
Dividends.
Dividend, good. All right, whatever that number is, it gives me the ending balance. So since revenue minus expenses equals net income, if my expenses go up, what happens to my net income?
Goes down.
Good. If my expenses go up, my net income comes down. And if my net income comes down, my retained earnings is going to be less, isn't it?
Yes.
Okay. And dividend also reduces my retained earnings. So notice that dividends do what? Dividends move in the same direction as expenses, but a dividend is not reported on the income statement. A dividend is reported what? Straight onto the statement of retained earnings. So we don't call it an expense, but it has the same effect on retained earnings as dividends do, right? Right?
Yes.
Okay. Guys, it's going to be important that you review material prior to class that we talked about last time, because we really won't have time to, reteach every single thing that we learned from the last class in the next class. Okay. So, but let's just look at this. Revenue is 1,000. Expenses are, say, 900. What's my net income?
100.
My net income would be 100. So if my beginning balance, let's get rid of these X's. If my beginning balance in my retained earnings was 0, I would take my net income of 100.
Mhm.
Let's say there's no dividend, so the ending balance would be what?
100.
Would be 100. Good. Okay. Now let's say I look and my revenue is 1,000, but let's say now my expenses are 950. So my expenses went up, didn't they?
Yes.
Correct.
They were debited. So what's my net income now?
50.
Now my net income is 50. So now when I put net income of 50, now my ending balance in my retained earnings is what?
50.
Is 50. Okay, good. So it's true that as expenses go up, retained earnings ultimately comes down because net income comes down, right? Right?
Yes. Yes.
Yes.
Okay, good. All right, now let's say I pay a dividend of 25. Let's make it 30. Okay, so if I pay a dividend of 30, now my dividends are going to be subtracted. So what's the ending balance in retained earnings?
20.
20.
The balance in retained earnings is 20. So what happens? When I pay a dividend, retained earnings comes down, right? Okay, but the difference is that what? I don't report dividend on the income statement. I report revenue minus expenses. I report net income on the income statement. on the what statement of retained earnings, I show the dividends coming straight out of retained earnings as I pull the stopper on the piggy bank and I pull money straight out of the piggy bank, right?
Yes.
Okay.
I have a question about, so what would be a good reason for a company to increase their dividends or start paying out dividends?
They feel that they have sufficient, it's a decision at the board of directors level of an entity. And potentially they feel that they have enough capital to accomplish any forward-looking objectives of the company, and they still have excess cash available. And so they decided they're just going to go ahead and pay a dividend at that point in time. So it's just that they have some cash and they know that the stockholders are probably sitting there at some point waiting for a dividend, and they just go ahead and make the decision to do that. They don't have to pay a dividend, as you know. Some years they may not pay a dividend. If they're having losses, it would be ridiculous for them to pay a dividend. If they're in a growth mode where they're making investments in property, plant, equipment, they're spending money on research and development, I don't want a dividend. If I'm a savvy investor, I'm sitting there saying, no, don't give me the cash, keep the cash, keep that train growing. But if they get to a point now where they're starting to be able to, you know, harvest some cash, if you will, that might be the time where they would go ahead and pay off a dividend. It's a board of directors level decision.
Gotcha. Thank you.
Question? Okay, good. So let's start to take a look now at how we're going to basically use this debit and credit process to make entries into our accounting system. And then we're going to see how we're going to pull our financial statements. Okay, so first you look at the transaction. Does it involve assets, liabilities? I don't know that you need a magnifying glass. And then you'll enter transactions into a journal, and then you will post those transactions to a ledger. And then after those transactions have been posted to the ledger, by the time we get prepared to prepare our financial statements, say at the end of the year, which is actually the easy part, we simply pull the account balances from the ledger and use that to prepare our financial statements. Okay, so what we're going to do is we're going to go through this example that you see on the slide. We're going to start up a little company here, and we're literally going to go through a couple years worth of transactions, and we're going to pull the financial statements and prepare financials for this company. Now, when we do this, it is, I generally do it on the Excel sheet. Can you can see this whole thing on the screen, can't you?
Yes.
Okay. So I don't know, maybe it's not necessary. Can you see it okay? If you're having trouble seeing it, guys, you can make the tiles of the class smaller and the thing bigger if you're having trouble seeing on the screen, but you can see it okay on the screen?
Yes.
Yes.
Okay.
Is that all for you?
Say what?
Dividends, or is there more than that?
What?
So the lowest thing that I can see is closed dividends. Is there more below that, or is that where we stop on your screen too?
Yeah, no, that's fine. Yeah. And then on the other
Just
side.
making sure it's not getting cut off.
What?
I was just making sure it's not getting cut off for me. I want to make sure.
Yeah. Oh, yeah. No, I think it's good. Yeah. Let's do this because I think it's easier. The thing that I was contemplating here, guys, and let's see if I can get out of this slideshow for a second and not have the whole world collapse on me. I'm going to discard that for now. Is in Canvas, I actually have an Excel spreadsheet for it, but I don't know that we get any more out of the Excel spreadsheet than we do the PowerPoint slide. So I'm just going to stick with the PowerPoint slide. But just so you know, there is the Excel spreadsheet that gives us the 2 years worth of transactions, but that same information is on this slide. And now I'm kind of thinking it might be easier to show you this on the slide. But if I run into trouble, I'm going to go over to that Excel spreadsheet. If I can't remember why I generally do it from the Excel spreadsheet at this moment, but maybe I'll figure that out and then I'll move over to that Excel spreadsheet. But right now, I think we can just do it from this slide. Okay. All right. Sound like a plan? Okay. Now, what happens? We record transactions in our journal. So as transactions happen, we record them in the journal. So we do that first, and then first record in the journal, and then we post to the ledger. Okay. Now notice our ledger contains our asset accounts, our liability accounts, our stockholder equity accounts, and we're going to use this system of debits and credits to keep this equation in balance at all times. Assets equal liabilities plus stockholders equity. Okay, so you start to take a look at this thing, and let's say our business is a DJ business. Okay, so we're a DJ, you know, and we're DJ Pizzazz. Okay, now my real name is Irving. I'm a human being named Irving, but I incorporate and I create this company called DJ Pizzazz. And this business is going to be all about having a warehouse or something, you know, a party space where people can come and have their parties at our facility, and then we'll DJ the party. Or we may go remotely to other people's places, their homes or whatever, or their party spot, and perform the DJ service that way. Okay, so we decide we're going to do that. So Irving takes some of the cash out of his personal bank accounts and puts it into the bank account of DJ Pizzazz Corporation, right? Okay, so did the cash of DJ Pizzazz just go up?
Yes.
The cash of the corporation went up because he put money in the corporate accounts. So should we increase the cash of DJ Pizzazz?
Yes.
How do you increase cash?
You debit it.
Good. So I go ahead and I debit the cash. Now, DJ Pizzazz wants everyone to know that he's the owner. I mean, Irving wants everyone to know that he's the owner of this corporation. So he takes back stock to evidence his ownership. So the corporation does what? Issues the stock now to Irving, right? Okay, so what happens? Since we issued the stock, our stockholders' equity common stock account has to go up. To increase a common stock account, you credit it, don't you? Okay.
Yes.
Just debited cash and we credited common stock. Now, how do you know that I debited cash? How do you know that I credited common stock? In accounting, we use the structure that we indent the debit to the left, we indent the credit to the right. Debit to the left, credit to the right. Debit to the left, credit to the right. You ever see an accountant walking around and they look all stiff like this? You know, you see these real stiff accountants walking around like this. That's because everywhere they go debit to the left, credit to the right. Debit to the left, credit to the right. They don't make a step without saying that, okay? So the debit to the left, credit to the right, we recorded that in the journal. Now we post that to the ledger, okay? Now posting is a very mechanical process, okay? All we do is we pick up this debit over here. Okay, let me go ahead. Maybe that's the reason I do it in Excel, because it's easier to mess with the pens and stuff. But what happens? We go ahead and we simply pick that debit up and we post it to the ledger. It's a mechanical process. We're picking up that $1 million and we're putting it in the ledger account on the debit side, because that was a debit on the left, credit on the right. And now that what? That ledger account has a $1 million balance. So when you look at the ledger accounts, they're like a scale, aren't they? So since what? We just have that debit right now, that's a $1 million debit balance in our cash account. Okay. Then we go ahead and we pick up this credit and we carry it over. $1 million is kind of heavy. We carry it over, we plop it on the credit side of the common stock account. And when we credit it on the credit side of the common stock account, now the balance in the common stock account is $1 million, doesn't it? Because debits equal credits.
Yes.
Okay. Now, don't write this down right here, guys. Eventually, I'm going to ask you to write in the financial statements. Don't write it down yet, okay? But right now, at this moment, I could prepare a balance sheet. Why do they call it a balance sheet?
Because it balances.
Because it balances. What balances?
Credit and debit.
No. What
Assets is equal to liabilities plus stockholders' equity.
Good. Assets equal liabilities plus stockholders' equity. Good. So do I have any assets at this moment, just after that one transaction?
$1 million cash.
Good. Assets, cash, $1 million. Good. Okay. Do I have any liabilities?
No.
No, liabilities are zero. So if assets equal liabilities plus stockholders' equity, then I should have a stockholders' equity account. Do I have one?
Yes.
I have what? I have common stock. And the common stock is $1 million, isn't it?
Yes.
Yes.
Does the balance sheet balance?
Yes.
Yes.
And the balance sheet balances. Why? Because I made sure to balance my debits and my credits, right? Debits equal credits at all times.
Yes.
Yes.
Okay. All right, good. Don't write that balance sheet down yet, because we're going to, after we record all these transactions you see here, we're going to do the entire set of financial statements. Okay. All right. Now, remember this DJ Pizzazz business, we're going to have parties at our place sometimes, right? And people will just come and they'll book the whole venue and stuff with us. So we need a building, don't we? So we go and we find this building, and this building location setup is perfect for our business. So we go to the guy and we say, look, I know you're asking $1.2 million for this building, but please sell it to us for $1 million, because that's the only cash we've got. The guy says, no way, I've got 3 people lined up out here. If you won't pay me $1.2 million, one of them will. Okay, we say, okay, please don't sell the building. Will you take a mortgage? We'll owe you the $200,000. We'll have a liability. We'll owe you the $200,000. Will you do that? And the guy says, okay, yeah. And he likes us because we're going to be handing him almost the whole amount in cash. And so he's willing to sell to us. Okay. So what happens? If we give this guy our cash, does the cash balance in the corporation come down?
Yes.
Yes.
Yes, it does. So we debit to the left. Debit to the left, credit to the right is what I want to say. Credit to the right. We credit the cash. We pick up that $1 million. We post it into the ledger. And when we do, now the balance in the cash account is zero, isn't it? Because the debit brought it up, the credit brought it down. It's zero, and it should be zero because I just handed my cash to the guy that's selling me the building. Okay. Then what happens? Well, the building is still paying 1.2. I'm paying cash, and I'm going to have a bill for 200,000. So I'm really giving up what? Consideration of 1.2 million. So I now have a building. To increase the building, I do what? It's an asset, so I debit it. I pick up that debit. I post it over here, right? Just posting is a very mechanical process, and I'm not going to always draw the arrow over, guys, but this thing will get ridiculous at some point if I keep doing that. But we put that debit there. Now the balance in the building account is 1.2 million. Debits have to equal credits, so I credit mortgage pay a bill of 200,000, because I'm going to have to pay this guy out 200,000 at some point, right?
Yes.
So what happens? I go ahead and I credit the mortgage payable. I bring that credit over to my ledger account, post it. Now the balance in the mortgage payable is 200,000, right?
Yes.
Now, sometimes they say, well, no, you can't put the building for 1.2 million because I have what? I have all the future economic benefit associated with that building now accrues to me, doesn't it? I can use it. However, what happens if the building falls down tomorrow? What happens? The former owner will look and say, look what happened to your building. He's not gonna say, oh, here's your $1 million, unless there's some defect that he didn't disclose to us or something. But it blows down by a storm or something. He's gonna sit there and say, look what happened to your building. He's not gonna sit there and say, oh, here's your $1 million back, poor guy. All right. So I have all the rights and risks associated with that building. So I put the whole 1.2 million down. Okay, now I could go ahead and continue on with my balance sheet. So do I have any more assets now? Well, do I have cash anymore?
No.
So cash is what, 0. But now I have a building, BLD is building, guys, of how much?
1.2 million.
Preparing the financial statement is the easiest part. You simply look at what your balances are in your list, write them down in the form of a financial statement. That's 1.2 million. Do I have any liabilities now?
Yes.
Yes.
I've got what? I've got this mortgage payable, mort payable. And what does mort mean?
Mortgage.
Mort
Dead.
means death. Mort means death. That means you're not going to pay this off before you die, probably, right? Okay. And so what happens, or you'll pay the last payment and then you'll die. Okay. And so what happens? We have this mortgage payable of 200,000. Do I have any stockholders' equity accounts? Yeah, my
Yes.
common stock is still $1 million. Does the balance sheet balance?
Yes.
Any magic tricks going on here?
No.
Just follow that system of debits and credits. Good. Now, remember, we said that our DJ, any question on that? Now, remember, we said that our DJ business is going to do what? Sometimes we're going to go and we're going to bring our equipment to the concert hall, whatever, right? Okay, so what happens? We need a vehicle to transport our equipment. And let's say that we want one of them fancy, you ever see one of them fancy, it's basically a van, but it's real fancy. It's black. And it kind of looks like a limo and it's got 2 big doors in the back. You've seen one of these things, right? So we want one of those. We want to show up in style, right? So we go to the dealer and we say, hey, can we get this one? We really like it. And the guy says, yeah, it's 150,000. And he said, do you have any money? And I say, well, we don't have any money, but we'll sign a note to pay that. We'll have a payable. Okay. Do you think the vehicle guy would do that for us?
Yes.
Yeah. Look, someday you'll buy a car with no money if you haven't already. You'll walk into a place, you'll sign, and you'll drive out with a car, right? Okay. So if you got good credit, face it. Believe me. LeBron James, if he walks into, the Lamborghini dealer or whatever, okay, the Rolls Royce dealer, they don't say, well, Mr. James, do you have any cash on you today? They say, sure. How many vehicles would you like? Sure, because they know he's got good credit, right? Okay, so they sit there and they sell this to us on credit. And so what happens? Well, we take the vehicle and we take the ownership of the vehicle. The vehicle is an asset. We debit the asset. We bring the what? We bring that debit over here. So the balance in the equipment account comes up 150,000. And we have a what? We have another payable 150,000. And so, I wasn't consistent in how I called it payment payable, vehicle payable over here. It's that same payable. It's a bill of 150,000, right? Okay. Now, when we prepare our balance sheet, okay, let's go ahead and let's just stick that vehicle in there now. Okay, so now we've got, I'm probably gonna have to move this stuff down a little bit. Okay, so now we have equipment. The equipment is what, 150,000?
Yes.
And now our liabilities, and guys, just to fit it in, we have two liabilities, one for 150, one for 200,000. That's 350, isn't it?
Yes.
Yes.
Okay. Is my balance sheet still balanced?
Yes.
My
Yes.
balance sheet still balances, doesn't it?
Yes.
Okay. Now notice I took the equipment as an asset, right? Because I have all the risks and rewards associated with that equipment, even though I still owe the 150,000 on it. If I'm driving that van out of the showroom floor, whatever, and as I'm turning the corner there, I hit something, what is the dealer going to say to me?
Too bad. You owe me the
Your
money.
car.
Look what happened to your vehicle. I own it at this point, right? Okay, so I have all the risks and rewards associated with that, and I have a bill that I owe the person 150,000 for that vehicle, right? Okay.
Yeah.
Okay, good. All right, now guys, I'm going to stop with this part now. That's why I didn't want you to write this down. I'm not going to continue to keep preparing financial statement after every transaction. We're going to go through the rest of these transactions, and then we're going to pull the financial statements together. Okay. All right. So I go and I do my first concert, and the first party that I do is DJ Pizzazz, and I get paid $200,000 cash. Not bad business, right? So what happens? They hand me cash. If someone hands you cash, does your cash go up?
Yes.
So how do we increase cash?
We debit it.
Debit it, debit to the left. I debit that 200,000. I post it to the ledger. Now I've got 200,000. I like my cash balance a lot better than I did a minute ago, right? When you provide a service, like we said last time, very religious, we call it revenue. Okay, we worship our revenue, don't we? Okay, we call that revenue. And so what do? To increase revenue, you credit it, credit to the right, and then I go ahead and I post that, and now I'm showing revenue of 200,000, right? Okay. Now I have to hire these lift guys, these big strong people to come and help me lift my equipment and bring it to the gig, and then they're going to help me load it back into the truck and unpack it over at my place, right? So I have to pay these guys. So they do all this work, and at the end of the night, they're pretty rough looking guys. They tap me on the shoulder and say, by the way, we want 70,000 for the work we just did. Am I going to argue with these guys? No, I'm going to say, sure, 70,000, you won't kill me, right? So I reach into my pocket, I pay them the $70,000, they drive away, and I'm like, they're gone. I'll never deal with them again. Thank you. Is there any more future economic benefit in the service they just provided me? No. It has what? Expired. So what do? Since I gave them 70,000 cash, I'm going to go ahead to decrease cash. You credit it, credit to the right. I post it. Yeah. Now my cash is 130. I got 200. I gave these guys 70. I got 130 left. And since there's no more future economic benefit associated with that money I spent, because they're gone, they're done, I'm not going to use them anymore. I would what? I would debit expense to increase expense. You debit it. My expense is now 70,000, right? As it posted over there.
Yes.
Yes.
Okay. Okay, good. Now, what happens? Well, DJ Pizzazz is pretty cool. But at the end of the night, DJ Pizzazz takes off his cool glasses and puts on his nerdy glasses, takes off his toupee, and becomes Irving. Okay, now I'm just Irving again, right? And Irving is hungry. Irving hungers for pizza. So what does Irving do? Irving reaches into the corporate bank accounts and does what? Takes out a dividend, reaches into the piggy bank and takes out some money so that he can receive a dividend. So now Irving can go and buy pizza or whatever it is Irving likes, right? Not GJ Pizzazz now. He's Irving. We call that a dividend. So if we take money out of the corporate accounts, does our cash go down?
Yes.
So the corporate accounts go down. So we credit the corporate account, cash 13. Now there's still 117 left in the corporate accounts, right? All right. And what? We have to record a dividend. Remember, dividends act like expenses. As they go up, we debit them and we go ahead and we debit dividend. And now we know that we had $13,000 of dividends this year, right?
Yes.
Okay. All right, good. Now we can go ahead before we do these other closing entries and we can prepare our financial statements. Isn't this exciting? We've been through a year of business. Now we're going to go ahead and we're going to prepare our financial statements. Now, it is important that you know that you first prepare the income statement. First, you do the income statement. Why do they call it the income statement?
Because reports the net income.
Good, because it has net income, so we call it the income statement. How do you calculate net income?
Revenue minus expenses.
Good, excellent. Revenue minus expenses. Good. Do we have any revenues? Preparing the financial statement is the easy part, guys. You just look at what's the ledger account and write it down in the form of financial statements, right? So do we have any revenues?
Yes.
We got what, 200,000?
Yes.
Good. Do we have any expenses?
Yes.
Just look at
70,000.
Good. Just look at the ledger accounts and write them down in the form of financial statements. So what's my net income? Not a trick question.
130.
Good. Not bad for a first year of operations, 130,000. Good. My net income's 130,000. Excellent. Okay. Okay, good. Now what? Let me make that look a little better. Even with my sloppy writing, I'm not happy with that. You know, I always had trouble lining up the numbers, guys. Ever since I was a kid in elementary school, I had trouble lining up the numbers. So I had a teacher one time that said, John, she said it in front of the whole class, John doesn't line up his numbers. And because John doesn't line up his numbers, he'll never do anything with numbers in life. Here, wherever you are. All right, so we have what? We have net income, 130,000, right? Okay, but if sometimes I don't line them up, you know, I've had that problem for a long time. Okay, good. Then what happens? Then we sit here and second, prepare the balance sheet. Wait a minute. What am I saying? Second, I got so excited about my story.
Retained earnings.
Good. Second, prepare the statement of an RE is retained earnings. Good. And I'm just going to do the symbol for the piggy bank here. So I'm going to have what?
The base beginning balance.
Good. Beginning balance. And since this is DJ Pizzazz's first year of business, beginning balance is
0.
0. Good. Then I add what?
Net income.
Good. I add net income. What's my net income? Well, I just
130.
pull it down from the income statement. It's 130, isn't it?
Yes.
Good. And then I subtract what?
Dividends.
Good. I subtract dividend. And did I pay any dividends?
13,000.
Good. I paid 13,000. So now the what? Now the ending balance, and now I figure out why I put the whole thing on the Excel spreadsheet because I'm out of room here. Now the ending balance is what?
117,000.
117,000. Good. So I've got an income statement. I've got a statement of retained earnings, don't I?
Yes.
Guys? Okay, so now I need my income statement, and yeah, I'm out of room. So how do I want to do this? I should have just gone with my game plan instead of trying to call an audible here in the middle. I'm going to discard. No, I guess I'm stuck keeping this stupid thing. That's okay. That's all right. It won't hurt anything. Okay. And now I'm going to go ahead, and I think the best way for me to do this is to put a new slide in. Okay. And let's just go ahead and do something like that so we can still kind of see what's over there. Okay. And now third, I'll prepare the balance sheet. And this is not going to work. Now I see why I did it the way I did. Okay, so that's okay. Let's go ahead and let's just do it the right way. So revenue was 200,000. Well, let me get on year one though. Revenue was what?
200,000,
200,000. Expenses was
70,000,
70,000. Thank you. So my net income,
130,000.
good, was 130,000. That was the first thing I prepared. And then my statement of retained earnings is the second thing. Statement of RE. And we had what? We had a beginning balance of 0. Good. We had to add the net income, which we brought down from the income statement, 30. And then we had to subtract the dividend,
13,000.
13. Yeah.
13,000. Thanks, guys. And so the ending is 117.
Yes.
Okay, good. That's probably why I had done this before on the Excel sheet, because I'm able to keep it, the financial statements all on one page here. So then the third thing I prepare is the balance sheet. Why do they call it the balance sheet?
It
The
balances.
Because assets will
Equal.
equal what? Liabilities
Plus stockholders' equity.
plus the stockholders' equity. Good. Okay, good. So now I go ahead and I start to look at, that's not going to fit, I can tell you right now. And I start to look to see if I have any assets. So I look, do I have any assets? Is cash an asset?
Yes.
Yes.
Our favorite. Okay, so we go ahead. Let me put cash. 117. Good. Do I have any other assets?
Equipment.
Good. I've got equipment, 150,000. Excellent. Good. Any other assets?
The building.
The building. So preparing the financial statement is the easiest part, isn't it, guys? I mean, you
Yes.
simply look what's in the accounts and you write them down in the form of the financial statements. What is it? 1,200,000?
Yes.
Correct. Yeah.
Okay. Any other assets?
No.
No.
No, it doesn't look like it. So I go ahead and I'll total that up. Total assets. Somebody got a number for me?
1,467,000.
Good. 1,467,000. Just add those up. Good. Now, move this down a little bit. Now I put my liabilities.
Yes.
Okay. And do I have any liabilities?
Yes.
Let's see. I've got, if I keep going up, I've got my mortgage payable of 2 and my vehicle payable of 150.
Yes.
Yes.
You mind if I just combine those and just call it liabilities?
350.
Sounds
Yeah.
good.
Call it payables, whatever. Pay a bill. 350.
Yes.
Yes.
Okay. And then I do my stockholders' equity. And stockholders' equity is going to be my common stock,
Mm-hmm.
which is 1 million. And what else?
Retain earnings.
My RE, my retained earnings. Now, if I were to look at the retained earnings account right now, the retained earnings account has a balance of 0 because I haven't posted anything
Yes.
to the retained earnings. Nothing has been posted to the retained earnings at this point, right? There's no journal entry yet over here that we've studied at this point in which there was any entry to the retained earnings. We stopped right here, didn't we?
Yeah.
But I can look at my statement of retained earnings right now, and I know that the ending balance in the retained earnings is supposed to be what? The ending balance in the retained earnings is
130,000.
no, the ending balance in the retained earnings is supposed to be what?
117.
117, isn't it?
Yeah.
Okay, so I go ahead and I just bring it down. So now my what? My, and I probably should have said total liabilities here just to be correct. Total liabilities is 350. And my total, even I can't accept that. My total stockholders' equity is 1,117,000, guys. Hello?
Yes.
Yes.
Yeah.
Yes.
Okay. Okay, and so now when I total liabilities plus stockholders' equity, the total liabilities plus stockholders' equity, what's 350 plus 1,117,000?
1,467,000.
1,467,000?
Correct. Yeah.
Is the balance sheet balance?
Yes.
Is the balance sheet balance?
Yes.
Yes.
Balance sheet balances. Did you see any rabbits jump out of any hats?
No.
No.
You're very, very tired and you're working too hard. Okay. There were no rabbits jumping out of hats. We simply sat there and followed the system of debits equal credits. And when we did, everything stayed in balance, didn't it?
Yes.
Yes.
Okay. Now we're still not done yet though, because right now we've got this issue that my, oh, not that one. Sorry. That my retained earnings is showing what? My retained earnings is showing 117. Meanwhile, back at my ledger accounts, my retained earnings at this point is just showing what? Where's my retained earnings? It's just showing 0, isn't it? Because I haven't made any entries into the retained earnings. So what I do is I go through a process that we call closing entries. Closing entries have 2 objectives. One is to turn my revenue, my expense, and my dividend accounts back to 0. I send them back to 0 at the beginning of the year because I keep track of them by year, don't I? When I talk about my net income, I say how much I made each year. When someone asks you, hey, how much did you make? You don't say, well, when I was little, my grandmother gave me $5 for being a good boy. No, you sit there and you say, what? Well, last year I made 130,000, whatever it is, right? Okay, so I need to turn my revenue back to zero. I need to turn my expenses back to zero. I need to turn my dividends back to zero, because when companies report dividends, they're just telling you what they paid this year. They're not telling you what they paid for the entire life of the company. They're just telling you, this is how much I pulled out of the piggy bank this year. So I need to turn those three accounts back to zero: revenue, expenses, dividends. And I need to do what? I need to get the correct balance showing in my retained earnings, which I know the answer is 117, but I just can't write 117 down there. I use debits and credits to keep everything in balance. Okay, so I sit here and I go through this closing process now. These are these closing entries down here. So, oh, come on. Nobody asked you for help. I'm not talking to you. What is this now? Really?
At the bottom right, you can zoom out.
Oh, okay. Thank you.
Yep.
Appreciate it. You mean you didn't want to see me just have a complete meltdown?
As fun as that sounds.
They had this one time. I was at a banquet and they gave away an award, a scholarship, and the scholarship was for the accounting teacher that had a heart attack and died during the class. I'm thinking to myself, so to reach that height, all I have to do is die while I'm teaching the class. And, you know, sometimes when you sit there and you see me going nuts with these things, you think, oh, here it comes. Okay, here comes the big one. Okay, so let's just go ahead and let's take a look at this. Now we have to do what? We want to turn our revenue account back to zero, our expense account back to zero, and our what? Dividend to zero. And we want the retained earnings account to show 117. Okay, so since right now, when I look at my revenue account, revenue has what? 200,000 in there, doesn't it? So to turn it back to zero, I need to decrease it, don't I? How do you decrease a revenue account? You debit it. I debit the revenue 200,000. I post that debit. Is it zero now?
Yes.
Yes.
Is that what I wanted?
Yes.
Good. Got the revenue closed. Now I got to close my expense account. So expense right now got a debit of 70. I want to close it. So to decrease expense, you credit it. So I credit the expense account. I go ahead, I post that credit over here, and now the expense is showing zero. Is that what I wanted?
Yes.
So my revenue account is closed, my expense account is closed. Good, got those done. Now, sorry guys, I probably should have done this a little differently. When I debit my revenue account, right, and I post that debit over there and that closes it, let me go back, and it's now zero. At the same time, then when I debits equal credits, I credit income summary for 200,000. When I credit this income summary account, I bring that credit over here and I credit it, it shows a balance of 200,000. So income summary is kind of a cool account because what right now it's showing me what my revenue was, right? 200,000. Okay. Then when I close my expense account, since I want to do what? Turn that back to zero, and it was a debit. So I go ahead and I credit that. I credit the expense account. Now it's zero. Okay. And in that same entry, I debit income summary. And when I debit income summary, what's the balance in the income summary account now? 130.
130.
Okay, so to close the revenue, I debited it, I credited income summary, that brought it up to 200. To close the expense accounts, I credited it 70, I debited income summary 70, and now the balance is 130. So the income summary is showing me my income, isn't it?
Yes.
Okay, now where does income go home at night? Where does
Retained earnings.
income live?
Net income,
Where does net income live?
income statement.
Well, that's where it stays for a minute, but where does it live
Retained earnings.
for its whole life? It's got to go to the piggy bank. It's got to go to retain earnings. Doesn't it? So right now, my net income is stuck over here in the income summary. It says, hey, can you give me a ride home to retain earnings? And I say, sure, I'll give you a ride to retain earnings home. It sounds like a creepy story, but whatever. I'm sitting here and I'm what? I'm going to get it up into retain earnings, right? And so what do? I go ahead and I debit income summary 130. And when I do, my income summary comes what? Comes back to
0.
0. And I do what? I credit retained earnings 130. And when I credit my retained earnings 130, and I go ahead and I post that to my retained earnings account up here, now, thank you. I gave it a ride. It's in retained earnings, isn't it?
Yes.
It's happy.
Yes.
Now all I need to do is what? Close that dividend account, because the dividend account is still showing a balance of 13,000. Remember, we said we wanted the revenue back to 0, got that. Expenses back to 0, got that. Now I got to get the dividend back to 0. So what do? I go ahead and I credit dividend for 13,000. When I do, it's back to 0, and I'm ready to start year 2. Now, with my company, because my revenue, my expenses, my dividends are 0, I debit my retained earnings. And when I debit the retained earnings for 13,000, now the balance is what?
117.
117. Is that the correct balance for it?
Yeah.
So I accomplished my objective through the closing entries. I debited revenue, I credited income summary, that closed revenue. I credited the expenses, I debited income summary, that closed expenses. Now income summary shows my net income of 130,000. To get it up to retain earnings, since it was a credit balance of 130, I debited income summary. It's now showing 0, which it should, because now I'll keep track of my income next year in there. And I credited retain earnings. Now the retain earnings shows 13,000. I go ahead, I had a debit in my dividend account, I credited it, that brought it to 0. I debited my retained earnings, that brought it to 117, and it now matches what was showing on my financial statements, on my balance sheet, and on my statement of retained earnings. Question?
Yeah, actually, I had one. On the revenue side, for the closing revenue, could I just spew what you just said?
Yeah.
So, okay. So when you close a revenue, the revenue is a debit, right? Because you're increasing your assets. Or sorry, the revenue is a credit. The revenue is a credit,
Correct.
right? So then you put 200,000 in the revenue credit, which makes sense to me. And then why did you debit 200,000? Is it because you're pulling that to the income summary?
Yeah, I need to make this 0. Revenue's got to start out next year at 0.
Oh, right. Okay, I see.
I got to make it 0.
Gotcha. Okay. So you have to zero out revenue, expenses, and dividends for year 2 because
Correct.
those have to be 0. Okay.
Correct.
Just getting it now.
To year 2, just to look over here, notice that revenue will start the year with 0, expenses start the year with 0, and dividend starts the year with 0, doesn't it?
Yeah.
It's got it. And
It's got
income
to, okay.
starts the year with 0. That must be because I keep track of revenues, expenses, income, and dividends by year. And I did that by going through those closing entries, didn't I?
Mm-hmm.
Okay, so we said that revenue is more like, the income statement is more like a movie. And year two is the sequel to year one. It starts over again. Well, probably not the best analogy because usually, as you remember from the first Godfather, Don Corleone died and left Michael in charge, whatever. So, it's not quite that example, but we're starting over, right, in that second year with the revenue, expenses, and the dividends and the income summary. The balance sheet is like our wallet, isn't it? Okay, so at the end of the year, when you fall asleep, if you have $117,000 in your wallet, is it still there?
Mhm.
Okay.
Yeah, unless you got some shady friends, I'm assuming, nobody snuck in your wallet in the middle of the night and took the money out. You should still have the 117, or if it's sitting in the bank, right? You still got 117,000 in the bank on January 1st. Is your car still in front of your house? Again.
Hopefully, yeah, not in Hayward.
You guys don't live in Hayward. You don't have to worry. Okay. So what happens? Your car is still sitting there. Is your house still there?
Yep, hopefully.
Okay. Do you still owe people money if you owed it on December 31st?
Yes.
Okay. So your balance sheet, when you look at the balance sheet accounts, notice, guys, that those carry forward. So cash starts with the beginning balance in year two of 117. There's our equipment. The van is still there. There's our building, etc. Right? Our liabilities are still there, aren't they? The beginning balances. So for our balance sheet, the balances carry forward. For our income summary, our statement of retained, for our income statement accounts and our statement of retained earnings, everything goes what? Well, I shouldn't say for the statement of retained earnings, because retained earnings will have what? Retained earnings beginning balance comes forward because that's what we retained from year one, right?
Mhm.
Question? What happens if something wants me to close that? Okay, good. Nothing bad happened.
I have
Okay.
another dumb one. I'm sorry.
Sorry, go ahead.
In terms of like closing, I haven't really thought about it yet, but like, why do you need to like close it out? Because in a sense, like you can just start next year's revenue, like zero, expenses zero, dividends zero. As long as you know your retained earnings, I think you should be fine, right?
Would you trust a pilot that talked that way? If the pilot said, oh, we don't have to watch the instruments. We know we're going to land eventually. We don't have to, do anything. We don't have, put the landing gear down. Why? Didn't we do that last year?
We get on the
Probably
ground
not.
either way.
Okay, so this is a discipline and a process that you have to do it a certain way. If you don't do these things, you start saying, I know what it is, the amounts are.
Mhm.
No. You will drive accountants insane. Start trying to do things like that. Everything happens with a journal entry. I told you guys the story, or maybe I didn't. One time I was on an audit and we were looking at how banks account for their loan loss. And in comes the high level person, I don't know what his title was, and he starts saying, well, let me explain the way banks account for loan loss because it's very unique. And I said, well, okay, what would be the journal entries around that? He says, I don't care about the journal entries. And I said to him, well, that's all I care about. If you can't explain journal entries to me, I don't want to fucking hear it. Okay, I need journal entries because that's what we've been doing since the 12th century. That's how we run these numbers through these accounts and make sure we're not dropping anything anywhere. If you start just saying, well, I know what the amount is, you start to have trouble. So you got to maintain that discipline of debits equal credits. Nothing ends up in these accounts unless they got debited and credited. So I've got to keep track of it that way.
Gotcha. Okay, that makes sense.
Question?
It sounds like there's a fair deal of trust the process. There's not necessarily there's not always a justification for everything other than the fact that it works and it has worked and it'll continue to work, right? Am I understanding that correctly?
Well, kind of. I mean, you are talking to an accountant. So, when we
Yeah.
look at Apple's financial statements, okay, there's your justification. If you want to,
Yeah. So
you got to do this. So, yes, you are right.
I guess to put
This is
my statement more into context. I was just saying, put my statement more in context. It's for the level at which we are training, there's not always going to be a justification that we need, just that it works. If we were to go more in depth in like MSA or a CPA type program, then we might get more into the weeds and you'd be able to explain more thoroughly, right?
No, I'm explaining it to you very thoroughly. The only thing that would happen in a CPA or an MSA situation is we would come up with weirder transactions for you to think about. For example, if a company issues stock options, when they issue the stock options, they have to debit compensation expense and credit an equity account called stock options. And they have to average that over the service period. So if it was a 2-year vesting period, you'd take whatever the value of the options is using a Black-Scholes model. And you would have to sit there and take that expense and average it over the 2-year vesting period once you determine the value of the options using the Black-Scholes model. But there's still be debit to the expense and credit to the equity account.
And I think that's what I mean by more in the weeds. I didn't mean to imply that you're not explaining thoroughly. It's just that there are more intense parts to this process that we don't necessarily touch here.
No, everything is a journal entry. Everything is a debit and a credit. And to increase expenses, you debit them. To decrease them, you credit them. To increase asset, you debit it. To decrease it, you credit it. To increase liability, you credit it. To decrease it, you debit it. To increase revenue, you credit it. To decrease it, you debit it. To increase stockholders' equity, you credit it. To decrease it, you debit it. What changes is more complicated transactions or more sophisticated transactions, but it all comes back to this.
Got it.
And you don't prepare financial statements unless you do this that we've just talked about here. So no, it's more, special situations, transactions and whatnot. But the debit and credit system, this is about as detailed as you'll ever probably get in debits and credits. So when I'm talking to my CPA students, I sometimes tell them, well, look, that we have a revenue here. So we know we have to credit revenue. So what's the debit going to go to? Well, if it's a revenue, the debit probably can either go to an asset account or it's going to go to a liability account is going to be your debit at that point in time. And the debit to the liability would be unearned revenue. So I can almost break any transaction down to these basics. You describe the transaction to me. And that's what FASB does, is they look and they say, well, this transaction really represents an asset. So we'll have to debit the asset, but if we haven't earned everything yet, then we have to credit a liability. If we've earned it, then we can credit a revenue. And then they go into more sophistication as to how they've talked about these different transactions, but it's still debits and credits.
Okay, that's fair.
This is not a financial statement analysis class, guys. This is Introduction to Financial and Managerial Accounting. So we're not going to sit here and say, well, now, I'll mention those things when we get into chapter, I guess it's 13, whatever. We'll start to talk about some financial statement analysis, but this is an introduction to the basics of what we do to create the financial reports. Question? Okay, I'm seeing 8 o'clock, so just about. So I think that's probably a good chance for us to take a break. We'll come back and we'll do if there's no other questions right now, we'll do year 2 when we come back, okay? Why don't we go ahead and come back at 8:10? Is that okay?
Okay.
Sounds good.
14-minute break, okay?
Sounds good.
Okay, guys, let's go ahead and jump back in and start to take a look now at year 2. Okay, so we've got our first year under our belts for our little DJ Pizzazz, and we still have our journal, we have our ledger. Remember now.
Hey, John, I don't think anyone's on because I think you said 8:10.
8:10, yeah.
Oh, I did. It's right there in front of me. Okay. All right. Thanks, guys. Sorry about that. You know, when I get about accounting, I get kind of excited here. So we still got 5 minutes.
Who
So.
doesn't?
Okay.
Actually, that 5 minutes, could I ask you another question on
Yeah.
the other example? So I guess I'm kind of confused with the retained earnings portion of it. So when you say you have a credit on retained earnings, that just means you made money that year, right?
Well, it means that I have retained more income than I have taken out as a dividend.
Retain more, right? If you credit it.
Well, if I had a loss for the period, so if my revenue was say 50 and my expenses were say 75, which can happen, then I'd have a loss of 25, wouldn't I?
Yes.
Okay, and then we'll just ignore dividends here.
Uh-huh.
And so then to close the revenue account, I'd have to debit revenue for 50. I'd credit income summary for 50. I'd have to credit my expenses for 75. I would debit income summary for 75. So if I'm looking at my ledger for income summary, I have a credit of 50 and a debit of 75. So the balance in there is a debit balance of 25, right?
Mhm.
And then I have to close that to 0. So I would go ahead and I would credit income summary for 25. I debit retained earnings for 25. And so now my retained earnings would have a debit balance
Debit.
of 5, which is basically a negative retained earnings.
Mm-hmm. Okay. Right.
Yeah.
Cool. Okay. So a credit on retained earnings is good, and a debit is no bueno for that year at least.
Well,
Okay.
if it ends up with a debit balance and retained earnings, yeah, that's not good. Okay.
Uh-huh.
And what some companies do, well beyond the scope of this course, if they've accumulated a large negative balance in the retained earnings,
Mhm.
they allow them to do something called a quasi reorganization. And with the quasi reorganization, what they do is they take amounts out of their paid-in capital accounts to zero out retained earnings. And then that gets them a fresh start. And as they go forward and they're starting to make positive net income, then they're hoping the retained earnings balance will grow over years. They call that a quasi reorganization.
Gotcha.
So you essentially what you do is you lower the par value of your stock to create additional paid-in capital in excess of par. that then creates enough additional paid-in capital that you can take out of that to eliminate the debit balance of the retained earnings. That brings retained earnings down to zero, and then they can start going forward from that. And companies will do that if they've had some negative net incomes in their earlier years. That's called a quasi reorganization.
Interesting. Okay.
Yeah, but that's way beyond the scope of what we're doing here. Yeah.
Thank God.
Yeah, if a company's showing a negative retained earnings, that can happen for a good company for several years in the beginning as they show losses period after period after period, right?
Mhm.
And that company's name is Tesla. And Tesla was showing losses year after year after year, as they were developing technology and whatnot, right?
Mhm.
Okay. All right. So now we can come back. So let me double check. Did I keep the recording going? Yeah, the recording's going right now. So, okay. So let's go ahead and let's look at year 2. Okay. And as we look at year 2, we have our journal, we have our ledger. Okay. Important takeaways from the ledger now, as we were saying just before we went to the break. The revenue is 0, expenses are 0, income is 0, dividends are 0. They have to start the year with 0. Meanwhile, my balance sheet accounts are what? My balance sheet accounts are sitting here and they are carrying last year's ending balances, right? Last year's ending balances for my cash, for my equipment, for my building, for my liabilities, my stockholders' equity accounts. They are carrying last year's ending balances, and that becomes this year's beginning balances, right? Question? Okay, good. So now I go ahead and I proceed now with my DJ Pizzazz business into year 2. And now I get a customer who's come to me and I like this person. I know them well. I've worked with them before. And they say, look, I'm going to have a party. I'm going to make money on it, but I can't pay you on the day of the concert. Will you go ahead on the party? Will you go ahead and perform your DJ service and I'll pay you later? Would you do that?
Yes.
Yeah, you'd say, okay, yeah, sure. Okay, we'll accept the money later. So what happens? I go and I do the DJing. I've earned the revenue. So I credit revenue. To increase revenue, you credit it. If I perform the DJ service, I can now recognize that revenue. So I go ahead and I credit the revenue, 100,000. I post it over here. So I've got a pretty good start to the year. I've made 100,000 of revenue. I can't debit cash yet because they haven't paid me the cash yet. But I go to my second favorite asset, which is accounts receivable. If someone's going to pay you in the future, do you have future economic benefit? Of course you do. So I go ahead, I debit my asset account receivable, and now I'm showing that I got 100,000 coming, right? Okay. Now, remember the nice van we had? Well, don't tell anybody, but we were essentially driving without any insurance on that. So we know we've got to get some insurance. So we call our insurance guy and he says, hey, you called me just in time. I got a great deal. I can sell you a 2-year policy. It'll cover 2 years. It's going to be $1,200 to cover 2 years. So I say, okay, great. So what happens? I got to pay him the $1,200. Okay, so I credit cash $1,200 and I debit the asset prepaid insurance $1,200. That's a prepaid because what? I've got 2 years of future economic benefit coming. I've got 2 years of insurance coverage coming, right? We're at the start of year 2, so I'm going to get insurance coverage for year 2 and year 3 in this example. So I've got future economic benefit, and sometimes students have trouble with this one, but it's called prepaid. It's telling you you have what? Future economic benefit coming for this insurance. Okay, then I go ahead and I get approached by a high roller. And this guy comes to me and says, look, I hear you're an up and coming DJ. You're DJ Pizzazz, aren't you? And I say, oh, yes, I am. He says, look, you're an up and coming DJ, and I want to secure you for a whole year's worth of service. And he comes to me July 1st. He says, what I'm going to do is I'm going to have a party, one for the 4th of July, one for, August, for September, October, Thanksgiving party, November, Christmas party in December, whatever. And then I want you to continue into the next year to provide me service in January, February, March, April, May, June in year 3. So I'm going to provide him 12 months worth of service. And he says, I'll pay you $10,000 per concert. So 12 months times 10,000 a month, that's 120,000 cash he gives me. He reaches into his pocket, takes a rubber band off the cash and peels off $120,000 to me, right? Are you going to take that money?
Yes.
Yeah, you take that money, but he's a pretty tough guy. He's not going to be none too happy if I don't show up, right? So I haven't earned that revenue yet. So I can't credit revenue because at that point I haven't provided one concert on July 1st, right? So what do? I credit the liability unearned revenue, showing the world that, hey, if I don't perform on this concert, not only is this guy going to probably have me whacked, but what? I'm going to have to at least give the money back to him, right? So I have a liability, 120,000. Okay. All right, good. Now I need some supplies. Okay, so I go to the DJ supply store. I don't know, I get some DJ wipes because my equipment needs to be wiped down at the end of the night or whatever. So I go in and I walk into the DJ supply company and they say, look, there's DJ Pizzazz. Nobody knows my real name's Irving, right? There's DJ Pizzazz. Hey, look, pick out any DJ supplies you need and we'll bill you later. Right? And they want to do this because they want to be the supplier of DJ Pizzazz, whatever, right? So I say, okay, fine. So I go and I pick out $24,000 of supplies that are going to last me a while. So I have future economic benefits, supplies to increase the asset you debited, debit on the left. I post that over. Now I've got 24,000 of supplies and I owe what? I owe 24,000, right? Okay. So I go ahead and I credit the bill, the liability, accounts payable, 24,000. Okay. Now notice something that's happened here, guys, with the revenue. Notice that I took the revenue, even though I haven't received the cash yet, right? So you need to purge from your mind this idea that revenue equals cash. It does not. Eventually, I'm hoping to get paid and it'll equal cash. But what generates the recognition of revenue is what? Is the provision of the service, the providing of the service. The thing that causes me to what? To recognize that I have an asset is not that I've paid cash out. It's that what? I've taken possession of that asset. So it could be that I'm now going to be obligated to pay some money to somebody, just like it was for the vehicle. Okay. So now the guy who I performed that party for calls me up and he says, look, I can't pay you the full 100,000 right now. Would you mind if I send you, say, 40,000 now, and then I'll send you the rest next year? He's a good guy, a good customer. I say, yeah, not a problem. Okay. And so what happens? I go ahead and he sends me 40,000. So I debit cash 40,000. That increases. Oh, I forgot to debit my cash over here for the prepaid, right? And then I debit the cash now because I provided the service. And he's paid me some cash now. So I go ahead and I debit the cash. I credit the account receivable for 40,000. How much does this guy still owe me? 60,000. This is why they invented accounting, guys, so that what? I can keep track of who I owe money to and what? I can keep track of who owes me money, right? And I know that this guy owes me 40,000. If the guy calls me and says, how much do I owe you? I say 40,000. Hi, John. Hey, you owe me 40,000. I make sure that they understand that I know how much they owe me. I don't sit there and go, hang on a minute. he doesn't know how much he owes us, right? So I'm keeping track of this so that I could at any point in time tell people, hey, invoice them, whatever, this is what you owe me, right? Okay. All right. So I go through the year, I make those entries for those transactions, and then I come to the end of the year. And at the end of the year, now I'm going to have to make some adjusting entries. Now, sometimes students get nervous about adjusting entries. That sounds hard, okay? If you're wearing a tie and your tie is crooked, what do you do with it? You adjust it. You fix it. You adjust it so that it looks straight, don't you? That's all we're doing with adjusting entries. We've got a little cleanup we've got to do with these accounts by the end of the year because we haven't quite been adjusting them every single time something happens. And so we're going to look back and we're going to see what adjustments, what things do we have to fix. Okay.
Before we get there,
Yeah.
on the fourth transaction, supplies of 24K are purchased. You had mentioned earlier to ask if we have this question. Is there anything in that prompt that indicates it's accounts payable, or you just know because you know the problem?
Yeah, good. Yeah. Thank you for asking that. No, there was nothing in that description that would have let you know that. So I probably should have said supplies are purchased on account or for credit.
Okay.
Yeah. Thank you
Thank
for
you.
asking. Yeah. There was nothing there that would have let you know it was an account payable. Other than the fact that we credit an account payable, right? But in the description, nothing. Yeah. Okay, so now we're going to start to make some adjustments. Let's go back to the guy that gave me the 120,000. So I performed the concert in July, August, September, October, November, December. God gave you fingers to count on them for problems like that. That's what? That's 6 months. Count on your fingers for those guys. When I was studying for the CPA exam, I was sitting there going 1, 2, 3. My dad says, what are you going to be, an accountant that counts on your fingers? And I was like, yes. Get out of here, Dad. You don't know anything about accounting. Don't tell me. I count on my fingers to remember to count my months, right? So it's what, 6 months. Okay. So since I provided the concert for 6 months, and he gave me the money in advance, I've earned what? 10,000 times 6. I've earned 60,000 of that, haven't I?
Yes.
So I go ahead and I now, because I've earned that, I can credit revenue 60,000. I go ahead to my revenue over here and I credit my revenue 60,000. Where'd you go, revenue? Right here, 60,000, right? And I debit the unearned, right? I debit it in the journal and then I post it over here to the ledger. I debit the unearned, and now the world knows that I've got what? I've got 60,000 left of service I still have to provide, don't I? Have you ever seen anything more beautiful than this? Look at this, poetry in motion. Look at this thing. It's beautiful. Okay. Okay, good. Now we're still making adjusting entries, and what happened? They sold me a 2-year policy, didn't they, for $1,200 on the insurance? But now it's the end of the year. 1 year has expired. 1 year of that future economic benefit has expired, hasn't it? It's a 2-year policy. So what do I have to do? I debit my insurance expense, 600, okay? And I go ahead and I debit that to my expense, 600. Okay, now I've got 600 of expenses I've taken so far. And I credit the asset prepaid insurance because I don't have 1,200 of future economic benefit now. I've got 1 more year left. I've got 600 left of future economic benefit, don't I? So as that expires over time, I go ahead and I make that adjusting entry. Okay. Then what? Then we've got those supplies. And remember, we bought 24,000 worth of supplies. And we go to the supply closet and we count, and there's only $13,000 of supplies left. This is just like a math question in, high school or wherever you studied it, right? Johnny had 24,000 apples. If he only has 13,000 apples left, how many apples did Johnny eat? Johnny ate what? 11,000 apples, right? I had 24. There's only 13,000 left. That means I ate 11,000 apples, right?
Yeah.
Okay, so what do? Well, I go ahead and 11,000 therefore of supplies have expired. I debit my supply expense. I go ahead and I stick that over here. Okay, that's 11,600 now of expenses. And I credit the supply asset account. When I credit the supply asset account, now it's showing there's 13,000 of supplies left. Have you ever seen anything more beautiful than this? Look at this. It's sitting there, it's 13,000. That's what I got left, right? And I'm showing that 11,000 has expired. Okay. Now, all I'm wanting to do here, because I am not going to ask you about depreciation on your midterm, but on your test. Okay. But all I want to do here is just show you that I would go ahead and I would calculate my depreciation on the building, and I'm ignoring the depreciation on any other equipment like that vehicle or anything. I just want to remind you that you would have to show that the building has depreciated, right? When we bought it, smelled brand new, it was brand new, everything was nice and shiny. And after what? After 1 year of using that building, it's not quite as new as it used to be, right? So I have to show some depreciation on that. So I make the calculation and I've determined that there's 50,000 of depreciation expense. So I go ahead, I debit my expense, 50,000. Now my expenses are 61,006. I credit the accumulated depreciation for 50,000. And remember, I show accumulated depreciation with my assets because they are contra to my asset. They'll be subtract from my asset. And I will do this every year that I use this building. I didn't do it in year one example, but every year that I use this building now, I will take this depreciation year after year. Okay. Okay, so I have gone ahead now and I have adjusted my accounts. I made all my entries for my transactions during the year. I adjusted my accounts. Now I can make up my financial statements. What's the first financial statement I'm going to do?
Income statement.
Good. Very good. First, I do the income statement. Great. Why do they call it the income statement?
Those net income.
Because it has net income. How do I calculate net income?
Revenue minus expense.
Revenue minus expenses. Good. Okay. So I come over. Do I have any revenues?
Yes.
160?
Yes.
Good. Do I have any expenses?
Yes.
Yes.
61,600. Good. Revenue minus expenses is my net income that I will report on the income statement. What's my net income?
98,400.
Thank you. Beautiful. 98,400. Good. Okay, then second, I prepare my statement of
Retained.
earnings. Let's go ahead and keep up our little mantra of the piggy bank. And it's going to be beginning balance. What do I add?
Net income.
Net income. What do I subtract?
The dividend.
Dividend.
Dividend. And that will give me BASE. That will give me the ending balance, right?
Mhm.
Okay, good. What's the beginning balance?
117.
Good. Beginning balance is 117, isn't it?
Yeah.
It's not zero anymore because we're in our second year of business, right? What's the net income?
98.
98,400. Good. What's my dividends?
0.
I didn't pay any dividend. Does a company have to pay a dividend? No. They decided not to pay a dividend. Dividend is zero. The 13,000 dividend was last year's dividend, right? Okay, good. So 117 plus 98.4 minus the zero dividend gives me ending balance and retained earnings of how much?
215.
Good.
Four.
215,400, you say?
Yes.
Okay, good. Excellent. Now I can prepare, what do I prepare third?
Balance sheet,
Why do they call it a balance sheet?
because it balances.
Because it balances. What balances?
Assets is equal to liabilities plus stockholders' equity.
Good. Assets equal liabilities plus stockholders' equity. Do I have any assets? What's your favorite asset?
Cash,
Money.
What did somebody say?
Money.
Money. Cash is my favorite asset. 275,800. Okay. If you have any cash that you don't want, let me know. Okay. I'll take it from you. Not a problem. Okay. 275,800, right? Okay, good. I still got that equipment. Okay, now guys, I didn't depreciate the equipment because I don't want to turn this into a 3-year exam, into a 50-hour example. So we got equipment, 150,000. Good. I come up and I'm going to skip the building for right now. How about my accounts receivable? Is that an asset?
Yes.
Okay. So I've got and we call it AR, accounts receivable. What was it? 40,000? 40 or
60,000.
60. I think it's 60.
Okay. Okay, good. How about supplies? That's an asset, right?
Yep.
So that 13,000 of supplies that I'll be able to use in the future. Beautiful. How about prepay? Still got 600, still got a year left, right? So that's what, 600? Okay.
Yes.
And then I've got the building. BLD is building, and the building account has how much in it? Just look at the building account, guys. How much does it have?
1.2 million.
1.2.
1.2, what I paid for it. But then I'm going to show the accumulated depreciation as a subtract. And the accumulated depreciation is what?
50 grand.
50,000. Okay. So I go ahead and I show that accumulated depreciation of 50,000. And I think that's all my assets, right?
Yep.
So my total assets is going to be 275.8 plus 150 plus 60 plus 13 plus 6 plus 1.2 minus 50,000 gives me how much in assets?
1,649,400.
Good. 1,649,400, you say? Good. Okay. Then I have to list my liabilities, don't I? Okay. So I've got what? I've got, and this example, again, I don't want to turn it into a 15-hour example. So I haven't paid anything on that mortgage payable yet, but I still got the mortgage payable, still got the vehicle payable, don't I?
Right.
I got the mort payable. $200,000. I got the vehicle payable. What was it? 150,000. I've got what? Any more liabilities? Any more liabilities?
Yes.
What I
Accounts
got?
payable and unearned.
Good. I got the accounts payable and I got the unearned revenue, right? Okay, so I'll list those out. AP is accounts payable. What is it, 24,000? Notice I still owe the 24,000. I've already used up some of the supplies. And then I've got the unearned revenue of 60. Good. Any other liabilities?
No.
No, I don't think so. Okay, good. So I go ahead and now I can add up my liabilities. Total liability is what? 2 plus 150 plus 24 plus 60.
434,000.
434,000, you say?
Yes.
Okay, excellent. Now I can do my stockholders' equity.
Mhm.
And do I have any stockholders' equity accounts?
Common stock.
There's that common stock still sitting there. Haven't any more stock, so it's still sitting at $1 million, right? What'd you say?
Common stock 1 million. Yeah.
Okay, good. Thank you. 1 million. And then I've got my retained earnings, don't I? Which I'm going to pull my retained earnings down to my balance sheet here. What's the retained earnings? 215,400. So I
Yep.
pull it down from the statement of retained earnings. Retained earnings are tell me the number again, 215,400.
Yep.
My total stockholders' equity is 1,215,400. And if I add my liabilities plus my stockholders' equity, total liabilities plus stockholders' equity, what do you get when you add those numbers together? 434 plus 1,215,000.
1,649,400.
Does the balance sheet balance?
Yep.
Did you see any rabbits jump out of any hats?
No.
No. We simply what? Sat there and adhered to the system of debits and credits, prepared the financial statements in the correct order, and we got the balance sheet to balance, right? Now, right now, we've got the issue that retained earnings is still showing 117. And again, we've got to close our revenue, expense accounts, our dividend account back to zero, don't we? Okay, that's the whole objective of the closing entries. So I look at my revenue, and since my revenue is showing what? 160, to turn it back to zero, I have to debit it for 160, don't I? So I debit the revenue for 160. I post that over to the revenue account. And when I post it over to the revenue account for the 160, now my revenue is zero. Is that what I wanted? I'm good there. I credit income summary, and I credit income summary 160. And when I credit the income summary 160, now income summary got 160. It's just showing me my revenue. Now I want to close my expense accounts. I've got what? I've got 61,600 showing there to what? Turn it back to zero. I'm going to have to credit it for 61,600, and I will debit income summary for 61,600. So I'm kind of doing this backwards because let's just look at the journal account. First, you debit in the journal, general journal, debit income summary, credit expense. Then you post it, debit the income summary, 61,600, credit expenses, 61,600. Now expenses are showing zero. I debit income summary. Isn't income summary a cool account? It does what? It shows me my net income, doesn't it? Okay, so now I've got 98,400, my net income sitting in income summary. But net income is saying, can you give me a ride to retain earnings? Because that's where I live. So I say, okay, yeah, I'll give you a ride to retain earnings. So what do? I go ahead now and I debit income summary 98.4 When I debit income summary 98.4, it goes to 0. I want my revenue expense and my dividend, my income summary counts to show 0, so I can start over next year. And then I credit retained earnings for 98.4. When I credit retained earnings for 98.4, I go ahead and I credit it. Now net income is in retained earnings. Thank you. Thanks for the ride. It's up there now. And now my retained earnings is showing 215,400. Is that's what it's supposed to show?
Yes.
Yep.
We didn't have any dividends in this example. You don't have to pay dividends. So there was no need to close the dividend account because it was already, it stayed at 0 the whole year. Question.
I just want to say, when you hear me giggling during the exam, it's because I'm doing that voice of the income summary in my head.
Okay, good. Whatever works for you. Okay. Yeah. Whatever works for you. You know, I think it's sometimes worth it to just kind of play little tricks with yourself like that. Like, what are you trying to do? I'm trying to get it to retained earnings. Whatever you got to do to help yourself with this stuff, it works. Whatever works, works. Question?
Oh, are you going to be posting up like the slides or the Excel that you're working on?
It's up there.
I mean, like with the colors and stuff.
It's marked. There's a marked up version too.
Oh, there's a marked. Oh, okay, cool.
Yeah. I think. Let's look. Let's see. Year two.
Second from the bottom.
Yeah.
In class example markup. Okay, let's make sure.
It's there. I've been using it the whole time you've been lecturing.
Oh, okay, yeah. So there, it's there. Well, it doesn't have all the colors, so you're gonna have to kind of follow that on your own. I don't think, does it have the colors? Maybe the colors just aren't showing in this version. Okay, good. Yeah, so it's all there. Okay, so there's a marked up version, and then there's also, going back to Canvas, there's also
In class, clean.
a clean version, and that doesn't mean, you know, it's good for, you know, children under 13 or anything like that. What that means is there's nothing on. So that one, what I recommend you do is it lists the transactions, but you got to fill in the journal entries. You got to post them.
Mhm.
Okay, so I would think that this is a good way to make sure you really understand what's going on with this thing. If you can fill this out from your just own understanding of what you should do when you see a description of a journal entry, you're going to be in really good shape. Okay. Okay, good. And then you have the recording. So what I would do, a good way to study is to take that blank, that clean version, whatever, and just play the video back. And then when we're ready to do the transaction, pause it, see if you can fill it out, hit play, see if you got it, right? Pause, play. So sometimes I get students, they say, so we don't have to do anything every week? And I'm like, no, I didn't say that. Just because I didn't give you homework questions doesn't mean that I haven't given you stuff to work with and practice with and strengthen your, you know, your knowledge of this stuff, whatever, your flexibility with it. I mean, you see that accounting is really a mechanical process. Okay, it has more to do with learning, like playing a piano, than it has to do with understanding some theory of how curves intersect. Okay, I mean, it's more, you read the music. The transaction was that they bought a building. You debit the building, you credit the mortgage payable. You play the notes on the keyboard that correspond to the note you're seeing on the page, which is the description of the transaction. Okay. Question. Okay, good. So with that, if you thought class was over by not asking any questions, you may want to reconsider that. So do you have any questions? Okay. All right, so let's go ahead. And what I want to do is I'm going to start this practice midterm for chapter 2. I'm not going to do these first 2 questions right now. We'll do them next time because I think it does more harm than good because you're tired and there's some weirdness about those questions that I don't want to get into at this time. Okay. And I'll show you those next time, but you should go ahead and look at those as part of your quote unquote homework. But I'm going to start this with you and then I'm going to turn you loose on it to complete it. We'll review it together at the start of next class. Okay. That's the game plan. So we're just going to start this right here. So we've got this number 3. I'm going to start right here with number 3. We got this Delta 72 company received cash advance of $700 from a customer as a result of this event. Okay. Now, first of all, the way you answer questions like this is by making the journal entry that's described by the transaction and then looking to see which of the choices makes the most sense to you based on the journal entry. So if I received cash, does my cash increase or decrease?
Increase.
Increase.
Cash increases, so I have to debit cash, don't I?
Yeah.
Does my cash increase? And if somebody gives you money in advance, customer gives you money in advance, have you earned it yet?
No.
No, I haven't earned that money yet. They give it to me in advance of providing the service, right? So I have to go ahead and credit unearned revenue, 700. Cash is what? Asset, liability?
An asset.
Asset, your favorite.
Asset.
Unearned revenue is what? Unearned revenue is what?
Liability.
It's a
Liability.
liability, right? If I don't perform this service, I got to give the person the money back. Okay. So is it true that assets increased by 700?
Yes.
Yes, it is. Now let's read the rest of them. Did stockholders' equity increase by 700?
No.
No, my liability was the other side of that. They increased 700. Did liabilities decrease? Choice C, by 700.
No.
Liabilities did what? Increase. That's why I credited the unearned revenue. Did assets and stockholders' equity increase? No. Assets and liabilities increased, right?
Right.
Okay. So what I'm expecting you to do, guys, is to be able to make the journal entry that's associated with it, but then how does that impact the financial statements? If I increase my asset, if I have a transaction and it increases asset, decrease liability. So you got to know the journal entry, but you have to know the impact on the financial statements. At no time in this class will I ask you to take a bunch of transactions and generate a full financial statement. I'm not interested in that. First of all, I'm not teaching you to be an accountant, number one. Number two, and I'm going to show you next time, they have software that will generate the financial statements as long as I understand the journal entries behind that. I don't need to sit there and go through that horrible process of posting, pulling the financials. I did it so that you see the big picture. That's the only time we'll do something like that in this class. But I do need you to understand the journal entry, when a transaction described, the impact on the financial statements, okay? And your midterm questions will look a lot like this, okay? All right, good. Let's look at number 4. Sebastian Bella has performed services of 2,000 of CPA services for a client, but has not billed the client as of the end of the accounting period. Well, if I haven't billed the client, then I hadn't made any accounting entries. So I have to fix that. I have to adjust that by the end of the year. So if I provided this service, can I take the revenue?
Yes.
Provided the service, so I can recognize the revenue. So revenue will increase. I'm going to credit revenue 2,000, right? Let me give myself a little more room here. Let's expand that a little bit. Here. Okay, so I've increased the revenue 2,000. I credited it. I'm billing, she's billing the customer, so that means that the customer isn't paying yet, right?
Yes.
I'm billing them. So if someone's going to pay me later, do I have a future economic benefit?
Yes.
I do, so I have to increase an asset, don't I? And we call that asset accounts receivable.
Yes.
So I debit the account receivable.
Correct.
Okay, all that one wanted to know was the journal entry. Now, let's say that then Sebastian Bella collects 1,500 on this. Okay, so if I collect cash, does my cash increase?
Yeah.
Good, so I'm going to increase my cash by debiting it 1,500, and I credit accounts receivable. So if we were looking at accounts receivable, just to make a little ledger account out of it over here, I debited it for 2, so the balance was 2, and then I credited it for what?
Service.
15. That's 15. So now the balance is what? 500. Is that what they still are owed?
Yes.
Good. Okay, let's look at another one. Froggy Company earned revenue of 200 in its first year of operation and incurred expenses of 700. As a result of these transactions, Froggy's retained will be, okay, well, if I have revenue of 200,000 and expenses of what?
70.
70,000, what's my net income?
130.
My net income is 130, good. And then if I prepare my statement of retained earnings, what's the beginning balance?
0.
Yeah.
0, because this is the first year of operations. What do I add to my retained earnings?
Income.
Net income, 130,000. I subtract dividend, but they didn't tell me anything about dividends, so I can't, just start making up stories here. So I'm going to just put that as 0. So the ending balance in the retained earnings at the end of year 1 is 130.
Correct. Yeah.
Okay.
A good year.
Okay. Yeah, not too bad. Froggy's a smart frog. Okay, he's doing all right. Okay. All right, good. Let's look at number 7. Froggy collects $120,000 on July 1st. Okay. If I collect cash, does my cash go up?
Yes.
So I
Yes.
know I have to debit cash 120,000. Sometimes I tell my students, hey, free your mind, your ass will follow. If you sit there and you just write down what you understand from the transaction, it gets easier to keep going with that transaction or that problem and understand what's going, instead of sitting there just stunned by the set of information, right? Okay, then what? On July 1st, 2015 for services to be provided between, guys, let's just make this between July 31st, okay, of 2015 and June 30th of 2016. So this is going to go over a year, isn't it? Right?
Yes.
From July 1st to they give them the money and they're going to finish all the services by June 30th. Okay. So, and then let's just make this on July 1st, 2015, which of the following best describes the impact of this transaction? Well, if I'm getting the money on July 1st, but I'm not going to provide any service until July 31st, then have I earned any of that money yet?
No.
Have not. So I have to do what?
Write it off as a liability.
Well, I wouldn't say write it off, but I have to record it as a liability, right? So I go ahead and I credit unearned revenue, 120,000. Guys, I'm
Yes.
going to correct you on stuff like that because I don't want you getting into a meeting with some idiot accountant and you say, yeah, write it off, and then they're the ones that correct it. So I don't write it off. I simply record it as a revenue, right?
Is it unearned revenue or
Yeah.
revenue?
It's unearned.
Okay.
Because they got the money July 1st and they're not going to provide any service until July 31st, right? Even though it's the same year.
Yes. Yeah.
Okay. So is it true that cash is an asset
Yes.
and
Yeah.
unearned revenue is a liability?
Yes.
Correct. Yeah.
So
Yes.
assets and liabilities increased?
Yes.
Okay. Now, as Froggy provides the service, let's say he provides 60,000 worth of services, what will he do? He will debit unearned revenue. Let me write it, the whole thing in. Unearned revenue for 60,000. And now you can recognize the revenue for the services he provided. You can credit revenue for 60,000, right?
Yes.
So is it true that liabilities decreased and revenue increased?
Yes.
Okay. So you can see, guys, the method here. Okay. Method is write in the transaction and then read the question, record the journal entry, and then look at the choices. Okay. I'm going to leave you to go ahead and do number 9. Okay. Well, I'll do number 9. But before I do that, don't worry about 10. I will not ask you depreciation questions on the exam. There will be no depreciation questions on the exam. Don't worry about 10. Don't worry about 11. Okay. Okay. Let's see. What do we have left? You want to just finish it?
Sure.
2 more questions?
Right? Let's just finish it. Okay. All right. And that way you don't have to worry about it. But do go back and look at the example year 1, year 2, and then look at these problems again. But we might as well do them together. So you got a recording of it if you get stuck, whatever. But Froggy Company purchased a building for 1.2 million. Froggy did not have the cash to purchase the building, but provided the seller a $1 million down cash payment and agreed to pay 200,000 balance for the next 2 years. As a result of this transaction, if I purchase a building for 1.2 million, should I debit building for that amount? Huh?
Yes.
Okay, good. So I'm going to debit building 1.2 million.
Yes. Debit the building.
Okay, good. If I provide the seller with $1 million cash down payment, am I paying out cash?
Yes.
Yes.
So what should I do with
Credit.
cash?
Credit.
Good. Credit the cash, debit on the left, credit on the right. Credit the cash, 200,000. I mean, 1 million. I need 200,000 to make this journal entry balance, don't I?
Yes.
You see how you put a journal entry together? And that was the point that I was making earlier. I don't care how fancy the transaction is. If cash is involved, you know you got to credit cash. If an asset's involved, you know you got to debit an asset, and you can always work your way to that weird part of the journal entry. If this one's that weird, but we go ahead and we would credit what? Mortgage payable. For the 200,000?
Yep.
That's a liability, pay a bill.
Yes.
Okay, so let's look at the choices. Is it true that assets increased 1.2 million?
No.
No, we had the asset building go up 1.2 million, but the asset cash came down 1 million. So assets really only went up a total of what? 200,000, right?
Yes.
Okay. Is it true that liabilities increased 1.2?
No.
Liabilities only increased what?
2,000.
200.
200,000.
Good. Is it true that assets increased 200 and liabilities increased 200? Of course, you can see that's highlighted. But yeah, my building came up 1.2. It's an asset. My cash asset came down 1 million. So net assets came up 200,000, didn't they?
Yes.
And the liabilities went from what? 0 to 200,000 because I recorded the liability.
So I'm only just realizing that the term double entry system doesn't imply that there's only one debit and one credit and therefore two entries. It could be 5 or 6 separate line items as long as the debits and the credits are equal to each other.
Correct. Yes, although that would be a monster of a journal entry if it was 5 or 6 line items, but yes.
Obviously hyperbole, but
Yeah,
okay.
right. No, I'm just saying, yeah, I know, I'm just trying to let you realize that they don't usually get that involved, there's that many lines. But yes, it doesn't have to just be 2 lines. It could be 3, 4, 5, 6, 10 line journal entry. But usually, we're talking about 3 or 4 accounts. Okay. Okay, good. Let's do this last one down here, and then we'll look at that other one when we come back on next week. We're not live next week, are we? Oh, we are, huh? We're live next week, aren't we? In person?
Yeah.
Before I forget, let me confirm that next week is 9/1.
Correct.
It's a live class, guys.
Yep.
You get that room together?
What? You talking to me? I don't think so. So that's a live class next week. So don't screw that up because they sent me an email today saying, did everybody show up? I don't know if I said this last time. They make a lot of money by building buildings for universities. Okay, they have people handing them money to build buildings, and they can't have buildings empty. So they want you to come back. Okay, so just make sure you're playing the game right. Okay, we'll see each other. I think after that, we get them out of the way early, and then we'll have one more, and then we don't have to worry about that anymore. Okay, so make sure you're coming in next time. We'll be in that same room we were in last time, whatever that was. Okay, but let's go ahead and let's knock this thing out. Okay, so they give me basically an income statement, don't they?
Yeah.
Yep.
Income statement. But for this company, revenues, expenses are more than revenues. Can that happen?
Yeah.
If you don't think so, go look at Tesla's financial reports because that happened for a long time, right? So yeah, company can have a loss for the period, okay? And so then it wants to know what is the balance in retained earnings. How do I calculate balance in return earnings?
Beginning balance.
BASE, beginning balance. Good. What was the beginning balance? In other words, the balance at January 1st, 2013, right? December 31st, 2012 was the ending balance of last year. January 1st, 2013 becomes the beginning balance, right?
Yes.
Moves forward.
Right.
So this is what, 50,000 is the beginning balance?
Right.
Oops, I forgot the little symbol. This is the piggyback, right? What do I add? Well, in this case, guys, since it's a loss, I don't add it. I have to do what?
Subtract.
I have to subtract it. That was the trick on this question. You don't always add, you don't add a loss, you only add a positive net income, right? So I have to subtract that. And then this Fugazi made the ridiculous decision of paying a dividend of 10,000 in a year when they had a, $5,500 loss, which no company in their right mind would do that. Okay, but we have to adhere to the facts of the problem. So I have to subtract the dividend, don't I?
Yes.
I'm just saying, in real life, I don't think a company would pay a dividend in a year when they suffered a
It was
loss.
10,000.
Huh? Oh, sorry.
It was 10K.
Thank you. 10,000. Okay. And so when I go ahead and I do the math on that, the ending balance then at what? Which the problem?
34,500.
13. Good. Is what?
34,500.
Good. Okay. Question? Okay, guys, introduction. I want to point that out because I know sometimes people say, oh, he's not going to show us, all these sophisticated transactions. And the answer is no, I am not. Because I have had classes where I start trying to show you different things. And then someone says to me, well, cash is on the income statement, right? And for a guy like me, that's like blasphemy. Don't you ever say that cash is on the income statement. Cash is on the balance sheet, an asset. And so we're going to sit here and we're going to make sure that we have the fundamentals down. You can play with these numbers when you're doing some sort of analysis in another class, but I want you to know what really goes into these numbers. Okay.
Okay.
All right, guys.
Sounds good.
Have a good rest of the night. We'll come back and when we meet on next week in class, we'll start with these and then we'll jump into chapter 3. All right.
Okay.
All right, have a good night.
All right. You too.
Thank you.
Study hard.
Thank you.
Thank you.
Thank you.
Thank you.
Good night.